foreign exchange market and exchange rate. For the first one is function of foreign market, transfer, credit, and hedging. So the second is fixed exchange rate, known as the peg exchange rate, which is the currency will be compared to the gold. Second, help to ensure the stability of the exchange rate. Okay, the advantage of fixed exchange rate is it is relatively well protected against the rapid fluctuation inflation. And for the disadvantage is the government need to maintain a huge amount of gold reserves to maintain its value. Floating exchange rate, known as flexible exchange rate, determined by market forces of demand supply. So for the advantage is first, absorb the shock of global crisis. Second, adjust the equilibrium automatically. And third, central bank will buy or sell amount of currency. Disadvantage, first, lack of investment. Second, prone to sharp fluctuation. And third, negative exchange rate. Factor affecting foreign exchange rate. So, for the first one is inflation will cause decline in currency value. Second one is interest rate. High in interest rate cause countries' currency to face appreciation. The third one is recession. When recession happen, it will lower the exchange rate between currency. For the fourth one is public debt, will lead to lower in value of exchange rate. And for the fifth one is terms of trade. Currency value will increase if country face high revenue in balance of payment and high revenue in current account. So next is concept of foreign exchange rate. When one country convert a currency into another's country. And in free economy, currency value will according to law of demand and supply. For the first graph is demand for market foreign exchange rate for New Zealand. There is increase in demand from D1 to D2. Second is when there is supply intersect between demand and supply, we get P1. And the equilibrium is at ER1. When there is increase in demand, new equilibrium is at ER2. There is increase for foreign exchange rate from ER1 to ER2. Depreciation refers to the decrease in domestic price of foreign currency. For example, at first, 1 USD equals to 3 ringgit and 80 cents, but after appreciation, 1 USD equals to 4 ringgit and 10 cents. Depreciation refers to the increase in domestic price of foreign currency. And after depreciation, Malaysia's currency is back to normal, which is 1 USD equals to 3 ringgit and 80 cents. This means there is increase in domestic price of RM. Exchange rate refers to exchange between two currency itself. For example, exchange rate between USD and Euro is 1.5 and exchange rate between USD and British is 2. Then, the exchange rate between Pound and Euro would be 1.6. Effective exchange rate. Weight average between the domestic currency and the nation's most important trade partners.
Arbitrating. Simultaneous buying and selling of securities in different markets in order to take advantage of different prices for the same asset. There are two types of market, market X and market Y. Market X sell apple for $1, meanwhile market Y sell apple for $1.5. As a buyer, we will buy at the cheapest price. For example, buy 10 apple for $10 and sell 10 apple for $15. The risk-free profit is $5. This is what we call arbitrage. If it frequently happens, supply in market Y will increase. Demand in market X will increase because people keep buying. So the price will increase in market X and the price in market Y will decrease. Spot rate and forward rate. Spot and forward transaction involve a payment and receipt of a foreign exchange within 2 business days after the day the transaction is agreed upon. Example of spot rate: Transaction agreed on April. After 6 months later, payment day on September. Rate on the April is not taken, but the rate on the September is taken in this transaction. Example of forward rate. Transaction on April. After 6 months later, payment day on September. Rate on the April is agreed to forward on the payment day on September. There are two types of forward discount and forward premium. On the present spot rate, forward rate is below the present spot rate. Forward rate is above the present spot rate on forward premium. Currency swap, an agreement in which two parties exchange principal amount of loan and interest in one currency for another currency. Swap rate is a difference of spot rate and forward rate. Hedging, avoidance of a foreign exchange risk or covering an open position, basically for safety. Speculation, accept and even seek out a foreign exchange risk or an open position, basically for risky profit.